Well, thank you for coming. Thank you to our sponsors, American Banker, Payment Source, and particularly to Bankers Hub, who's videotaping today's presentation for an interactive online workshop we're going to do as well. So in the future, if you can't make it to conferences, check out Bankers Hub, as it's a great alternative to maximizing your travel dollar. So I'm excited to kick off the 25th annual Card Expo and Forum. I think they're going to need to change their name very shortly, especially an exciting milestone. The concept of a card will not make it to 30 years if I had to predict. I think, cards as we know them for payments, transactions, loyalty, and identification even are going to be replaced by the mobile device. So we're going to need a new name for this event. But regardless, the growth of mobile has certainly surpassed any, even those conservative analysts' expectations in terms of how quickly the channel would get adopted. And I think it's time to start looking beyond the initial table stakes of retail banking mobile solutions. Getting your balance, transaction history, even paying bills and depositing checks are great functionality, but it's just the first generation. And if we want to go further, we need to start getting the rest of the enterprise and other lines of business involved in the conversation and looking at new ways to engage customers and interact with them differently across the channel. So we'll talk a bit about how to do that today. Before I get into that, let me talk a bit about Pervasive Path. We started the company 2 years ago with the goal of helping companies make the most out of mobile. And we do that by helping them understand the mobile opportunity as it relates to their industry and their organization, and then helping them craft a strategy and business case to capitalize on that opportunity. Because we're focused on strategy, we have the opportunity to step back and identify the right technical solution from an architecture and integration standpoint for that institution's specific environment, and then work with either the existing mobile provider or bring the right partners to the table to bring that solution to bear, rather than trying to push a given technology that we have in-house. And once we've deployed that solution, we can then work with the organization to understand how to set up the governance and collaboration across the enterprise to make that a success, both in terms of marketing and customer adoption. We've led implementation of 40-plus mobile banking applications across 40 major banks and credit unions in North America, including 8 of the top 25 institutions. Everything from SMS to get your balance to mobile websites and applications to allow you to take a picture of a check and deposit it. We've powered over 500 million transactions across those different institutions with our solutions. We work with a large greeting card manufacturer. I'll take your question. Yeah, we work with Bank of Montreal and TD Bank. We work with a top greeting card manufacturer to work on their digital strategy across their interactive properties, and also to redesign a field service application for 15,000 merchandisers who would go in and do seasonal card change-out, rearrange shelves, etc. And then we also created a mobility center of excellence to help them build out that solution, as well as create the capability to service mobile initiatives across the enterprise on a global basis. Finally, we work with a Fortune 50 insurance company to prioritize mobile initiatives across the organization, different lines of business. We identified the top 25 projects they needed to tackle over the next 3 years and put together a roadmap to help them achieve that goal. So I want to talk today about the mobile opportunity and the imperative that it creates. Talk about the next generation financial service opportunities in mobile and the benefits of those different offerings. Talk about the mobility platform and capabilities that you can build out within an organization and how to best do that. And then talk about some lessons learned from the industry. Hopefully get some input from you guys in terms of your experience. It's going to be informed primarily by my U.S. experience, as most of our experience was in North America, but most of it will apply globally. If you have questions in terms of global, please stop me and we'll talk about them. Absolutely. Yeah, because we are recording for the web, I need to remember to repeat questions. So I will try and remember to do that. If not, please remind me. So mobile is without a question poised to dramatically change our industry. We're seeing it, as I said, being widely adopted in a big way. It's growing 30% year over year over the past 3 years, and it's expected to reach as many as 100 million customers in the next 3 years, which represents just under half of U.S. account holders. So it's going to grow very quickly, and we're seeing that similar growth internationally. It's changing the way we interact with our customers and turning the economics of a traditional financial services relationship on its end. We're seeing a decrease in the number of branch visits. Just a few years ago, it was 27 times per year the typical customer would go into a branch. Today, it's just over 3 times a year. And technologies such as remote deposit capture are only furthering that trend and alleviating the need to go into the branch. And then technologies such as bill payment are automating the payment process, so we're not even touching that customer digitally as often as we would because things are automated. And therefore, we're changing the engagement model and also the mind share that we have with that customer. So while these mobile automated interactions are great in terms of cost savings, they definitely do change the customer relationship, and we need to do things to combat that and to augment other areas to make up for that change. So why is it so important to care about mobile? The short answer is because our customers do. What we're finding is that customers are adopting mobile, they want mobile services, and they're prepared to change banks to get it if they're not getting it from the current provider. 7 out of 10 customers have said they would change banks, or at least very likely to consider changing banks if they can't get the services mobilely that they're looking to have provided. And a recent survey by Gallup organization told us that by better engaging our customers via mobile, we could increase customer loyalty by as much as 37%. So that's obviously a very big financial cost savings in terms of not losing those customers and also not having to go out and acquire new customers to replace those. But it's also an opportunity to do more with the customer relationships that you have. Mobile provides an opportunity to extend the dialogue, create cross-selling and upselling opportunities, and extend the value of that customer relationship. And finally, it's a chance to reduce cost in terms of number of times you touch that customer, in terms of calls from the call center or tellers, which means lower support costs and a lower relationship cost for that overall banking relationship. So that's great, but how do we go about increasing adoption? It's one thing to say customers want it and we know it's important. It's another thing to figure out how to do it. So what we're finding out today is by an overwhelming majority, 57% of customers are saying the reason they don't use mobile banking today is because the bank doesn't meet their current needs. That means either they don't have the capabilities the customer is looking for on their mobile offering, or the capabilities they do have are poorly implemented and not servicing the desires the customer is looking to fill. So we need to figure out how to address that gap. And the table stake functionality that I talked about before is a good start, but it's not going far enough. To really service a customer on the mobile channel, we need to think about it not just as a single point interaction, but a holistic conversation across customer touch points. We need to let the customer interact via their channel of choice, when they want, where they want, and how they want. And we need to be aware of those interactions on other channels. So, for example, a customer might receive a low balance alert via SMS, but that customer has a choice in how they respond to it. They may respond back to transfer money from their savings account via SMS again, or they may launch the mobile banking application, or they could call into the call center or walk up to a teller. Regardless of what channel they choose to interact on, that person they're talking to needs to know that they received an alert and why they received that alert, so they can engage them without having to backtrack and refresh the conversation. Additionally, if I schedule a payment via online banking, when I look on the mobile channel, or for the same matter on the ATM or the IVR, I should see that that payment is in pending status. So each touch point needs to be aware of the interactions I've had on another channel. That requires complex interaction between the channels, and one that many banks today have not set up to handle. So we'll talk a little bit about how to do that, but I often joke that mobile projects end up being middleware transformation projects, because even though banks have middleware today, they're not well suited to handle this cross-channel interaction like I'm talking about. So once you do decide you're going to target a customer on the mobile channel, you need to put yourself in their mindset. It's not a one-size-fits-all solution, and you need to look at the way a customer wants to engage on that channel. The detailed granular transactions we see on the website don't make sense on the mobile channel, and the interactions that do make sense on a mobile channel need to be tailored for the consumer's mindset. So there's really three ways that we look at a consumer interacting with the mobile device. The first is lean back. This is when you're on the couch watching TV, laying in bed at night. You're passively consuming content. You may be entering a few things to do a lookup, but primarily you're in the consumption mode. And you want data presented to you, but you don't want to have to drill down. You don't want to search for it. You don't want to manipulate it. On the other hand, there's the lean forward method, where you're actually taking time out of your day to interact on that channel. You probably step out of your busy interactions. You're standing on a post in a corner somewhere, looking down at your phone and doing a more detailed transaction. This is closer to a website functionality because you have the consumer's attention and interest, but it's still not the same as a desktop because you don't have a mouse, you don't have a big screen. So again, you need to be a different type of interaction. And the third one is the one where most of us find ourselves, and that's on the run. Running through the airport, I realize I need to make a dinner reservation because I forgot my anniversary. So I want to get that done before I hop on a plane. So I want to do things very quickly. 3 clicks is the guideline thing. If I can't do it in 3 clicks, it's taking me too long. So I need to recognize that I'm multitasking. I don't want to have an in-depth conversation. I don't want to enter a lot of data. I want to very quickly get to the screen I want to get to, and then transact my business and move on. So we need to design that and not try and throw the kitchen sink at the customer, but try and tailor the interaction for what they're looking for. The customer expectation is that it should be able to do things. The most common transactions within 3 clicks. So when you know they're on the run, you want to tailor the interface to provide those common transactions, those on-the-run transactions within 3 clicks. When they're leaned over, they're going to have more time, and they may go down to the 10th function, the 11th function, and drill down 3 or 4 screens. We'll talk about that in a minute. But when they want to do something quickly, that's when you need to be prioritizing the functionality. So what was about real-time conversations? During the Super Bowl this year, where 120 million people were watching the show, a survey showed that 38 million people had a second screen that they were using to watch the game, to look up additional statistics, to tweet and comment about the game on the mobile device or on their tablet. And Oreo took advantage of this by having a social media tiger team ready to take advantage of any events that happened during the Super Bowl. Well, anyone remembers this year's game, it was a little bit out of the ordinary in that we had a 38-minute blackout middle of the quarter. Well, during that 38-minute window, Oreo produced and released via Twitter this advertisement. It's just a simple picture that says, Oreo, you can still dunk in the dark. But it caught on like wildfire. It got 15,000 retweets and 20,000 likes on Facebook within a week. This is the type of reach that advertisers dream about. This is what they, the type of engagement they want to get. And Oreo did this by having a tiger team standing by that included their digital design agency, their marketing, their traditional marketing agency, their product owners, their legal team, and so on and so forth, to make sure they were ready to produce and approve an ad to go out in that time. And it paid off for them. Where advertisers are traditionally spending $4 million for a 30-second ad, Oreo, with a very simple picture, got you probably more reach and engagement than they would have. Now, I'm not suggesting we can all afford a 15-person Tiger team to manage every customer interaction, but we can understand that real-time desire and those real-time interactions that we're striving for, and try and design knowing what we do know and what we do have at our disposal. So we have the mobile device, and that device might have a different screen size, it might have a different form factor, it might have different capabilities, but we can determine all of that when we start the interaction. So we can tailor the user interface to look nice on the screen. That's step one. Step two is we have the ability to connect to the public internet, to private clouds, and to enterprise backend systems to get information that's relevant to that customer. And then we have contextual information, including the user identifier, the location, the camera, the microphone, the accelerometer so we can tell if they're moving. And we can really find out a lot about what that customer is doing based on those contextual clues. So if we take a look at the GPS coordinates and then just pull it again 30 seconds later and they're a mile down the street, they're probably driving very fast. And we might want to go to a heads-up display or a dashboard type view versus a detailed screen. If it's a city stationary, we'll give them that more detailed view. Now, you always want to give them the ability to override that because they may be sitting passenger in the car and they want that detail. But let's try and default to a behavior that we think they're going to be looking for. And then on top of that, we also have the social media profile as well as the past history. So we can marry all this information up to really tailor the experience to what we think the customer is looking for and create that real-time conversation servicing their needs in particular. Once we know what we want to do, we have to make sure that the design of our mobile application supports that functionality. Good design follows the function, not the other way around. So it's great if it looks pretty. It's great if it has slide-out menus or pretty drop-downs or shake to log out or other cool features. But if that doesn't make sense given the user's context and desired interaction, then it has no business being in the application. Really what we strive to do is understand why did the customer reach into their pocket at that given time, pull up their phone, and what do they want to get done right then and there. And we should try and service that need as quickly as possible. So with that in mind, let's talk about some of the next generation capabilities. Before I jump into this section, any other questions or thoughts on how we service the customer and the engagement models? Okay. So there's a lot of next generation services that are coming down the pipe and things you should be thinking about. They include customer alerts, QR codes, P2P payments, customer self-service with predictive analytics, remote imaging, wallet, augmented reality, gamification, and ATM interaction. It's just an example of some of them. I'm going to talk about the ones that are on the left. I'm not going to go into the ones on the right. We're certainly going to have plenty of opportunity to hear about wallet and payments over the next couple of days. So I thought it was more important to focus on the others. But are there any other next generation services you're hearing about, have seen, or we're hoping to get out of this session that I can talk about? Okay. Well, then we'll jump right into them. The first is customer alerts. As I mentioned, most mobile banking solutions today offer some kind of alert. Low balance alerts was the example I gave previously. And that's great. Alerts are a very powerful tool. And this is where a customer has given us permission to contact them on their mobile device. That's very powerful because the mobile device is the one thing we have with us more than anything else, more than our keys, more than our wallets. I spend more time with my phone than I do my family. It's sad, but it's the reality of life. So what we want to do is take advantage of that. We know that 97% of text messages are opened by the customer. I think it's like 86% are open within the first hour they're received, as opposed to a 16 to 17% open rate for emails. So when you send a text, you're going to get a reaction from the customer. You're going to get their eyeballs and their attention. You want to make the most of that permission that customer is giving you. That's really what this is permission-based marketing. So there's a lot of trust that goes with that, and making sure you're delivering the right message that's meaningful to that customer. But it is very powerful, so you do want to take advantage of that medium. So in addition to sending out low balance alert information, so the basic contextual information, let's take it the next step further and ask the customer to engage with us in a two-way conversation. For example, fraud monitor. Let's empower the customer to help us fight fraud. So if we know we have a suspicious transaction, the traditional model is to call the customer on the home number, leave a message asking them to contact us at the meeting, and hopefully emailing them to get them to call us. Well, if somebody's traveling, particularly overseas, they may not be checking their email because data rates are very expensive, and they're certainly not going to get a phone call to their home number. When we don't get a response from the customer, what do? We turn that card off, assuming it's a fraudulent transaction. If anyone's ever had their card turned off when overseas, you know how painful that can be and disruptive to your experience. And if it was incorrectly turned off because you did make that transaction, you'll likely be fairly disappointed with the bank, put it mildly, and you may end up switching banks because it was such a negative experience. So we want to avoid those false positives. So what we can do is send a text message saying, your credit card was used at XYZ location for Y dollars. Was this you? And we know they're going to receive it because 96% of text messages are received. And then they can respond right back with a yes or a no via text message. If they say, yes, it was me, great, sorry to bother you, enjoy your trip, have a great time. Close up the fraud account, don't shut down their card, customer goes about their business happy, you've mitigated your fraud risk. If they do say, no, this wasn't me, they're going to be panicked. Say, okay, we've immediately been validated the transaction, and we will have a call center representative contact you within 3 minutes, 5 minutes, whatever your current queue wait time is. Give them that live information, and then call them. So they know they're going to be responded to immediately. So if they're nervous, which they likely will be if they've had a fraudulent transaction, they know somebody from the bank will be reaching out to them very shortly. And give them the opportunity to provide an alternate number, because you say you're going to call me in 3 minutes, but as I said, I'm not at my home number. So maybe I want to give you a hotel number that I'm staying at in Europe, or I want to give you a friend's phone number, whatever makes sense. The other opportunity is bill payments. When a bill is due, we sometimes send a text reminder to a customer saying, don't forget your bill's due on X date. Or it would be great if we said the bill's due in 10 days, would you like to pay it now? Yes, respond yes, and we'll automatically process it from your default account. If they respond, great, it gets paid, and everyone's happy. If they don't respond, we can remind them again the day before it's due. So your bill's due tomorrow, would you like to pay it for a $5 expedited fee? Well, yeah, if I don't pay it, the bill pay provider is going to charge me $30 late fee, so I'd gladly pay a $5 fee to avoid that. Now the bank gets a revenue opportunity, and the customer is happy because they've avoided $25 in charge. Not allowed? Oh. Well, you're not saving them anything, so. So I talk about these as SMS, and SMS is the most common because it's the widest used to the 390% of devices can receive an SMS message versus mobile web, 43% of phones, and 22% can receive apps. That's globally. So you send an SMS because you know you're going to reach somebody with an SMS, but if they have your app installed, you may want to convert that to a push notification. Because then it launches directly into the application, and they can respond in the app in a more rich dynamic environment. They can see the additional ancillary information. So it doesn't make a lot of sense to me to send an SMS message to a customer that you already have a push notification relationship with. You can translate that to a push notification and keep your records in the sync so you know when they just uninstall the application or close out that account, you need to switch back to an SMS. It gets complicated, but it's important and really good for the customer experience. The next thing is QR codes. So we've all got statements like this. You apply for a credit card, it shows up with a picture on the front saying, activate your card today. Well, if you're like me, you triage your mail in the kitchen, and you throw away everything that's not useful. And because of that, I don't have a computer in my kitchen, so I generally pick the phone and call the 1-800 number, and I'll activate my card via the phone. And before I can get any of the cross-sell motions that they're pushing to me on the phone, I've hung up and I've moved on. If I do go into I'm only taking the credit card with me. I'm throwing away all the paper insert. So the ideal way to do it would be to replace that printer with one that includes a QR code, so I can simply snap that code, enter my verification information, and immediately activate that card. Now I've got a screen that I can push other offers to that consumer right at the point of activation. And then while I'm at it, I've got this piece of paper sitting alongside of it. I know it's a new account. That gives them the ability to sign up for e-statements and install the mobile app right from the paper insert as well. So we're bridging the physical-digital divide. We're giving them a physical piece of paper and a physical card, but we're inviting them to continue the conversation on the digital channel. Another thing to think about is person-to-person payments. This technology is going to probably be the next big one to take off if I had to look into my crystal ball. And that's simply because Chase started advertising for it. When Chase started advertising check deposit, my phone started ringing off the hook that every bank wanted to have check deposit. I had to remind them that Chase had a 5-year, $5 billion head start on them. But nonetheless, it's important. Consumers are clamoring for it, so of course the banks are clamoring for it. So person-to-person payments is going to be very important in terms of consumer convenience. 44% of customers surveyed has said that they want to have the ability to transfer money between accounts outside of their own banking relationship for person-to-person payments. So it's a very strongly desired consumer function, and so we need to provide it to them in a quick and seamless manner. And that should be, we have to think about things like security, because obviously as soon as you open up the mobile banking relationships to outside of your accounts, there is a greater risk of fraud and the ability for me to take your phone and send myself money. So we need to address those concerns. I'm not saying we should just throw it out there. We need to address the security concerns, both real and perceived, because those will inhibit adoption. But once we figure out how to do that, and Chase and others have figured that out, then we can go ahead and start pushing towards adoption.
Are they thinking about AML implications of that as well? Money laundering? For transactions of dollars?
Yeah, so like the multiplier capture P2P payments will have thresholds that will be set at the customer level. Right. So based on your individual relationship, you'll send in a parameter to the banking application saying this customer can transfer up to $500, $1,000, $10,000, so on. And that's what happens with remote deposit capture today. It's not the same limit for each customer. It's based on a number of factors determined by the back-end systems. The other thing is the recipient of that payment ought to be anybody. It doesn't necessarily need to be somebody with the same financial institution. I've seen P2P payments done both ways, and the first way is of doing it within the institution is of limited value. If you know Metcalfe's law, it says the value of a network is exponentially related to the number of users connected to that network. So what that means is if I limit it only to the network of my banking customers, it's only marginally valuable to those customers. If I open up to the entire universe of mobile customers, that's 100 million people within 3 years. That's an exponential growth and exponential value that we're having. So you want to, again, the security consideration, you have to figure out how to open it up to everybody, or else it's simply not going to get adopted. And somebody else who has a solution that services everybody is going to displace it.
What are your thoughts on the future of P2P payments and just the barriers that exist now between the charging expenses between the different companies? So if I want to pay my rent, my rent, or see a solution site?
I think traditionally rent would hopefully be done by as a bill payment, but if service providers or even one-off payment to your landlord on a less formal relationship could be done via P2P. But then the question is somebody has to pay the fees, and it's a question of who wants to pay that. It's a convenience fee. So I would argue that the landlord shouldn't have to pay it because he's leasing a check and he doesn't care. You want to pay it via mobile, so you should be paying that convenience fee. The person who's driving it via mobile transaction should pay the fee. if I want, if we're sitting in the room and I want you all to pay me right now before I start the presentation, I'm demanding a mobile payment, an immediate payment, and therefore I should pay it. Does that make sense? Does that answer your question?
It does. It's just that it's hard to see a promising future for immediate payments in terms of that. Because of that reason, people don't want to accept that. By trying to pay that and displacing the cash by credit card.
Yeah, I agree. I actually went to rental properties, and people want to be in Japan, PayPal, whatever the credit card account is, and I'm getting things but fairly high rate of interest. But they're the ones asking for it, and I said, okay, I'll be happy to take it, but you have to pay the fee. Nobody wants to do that. Right? If there's a way they can come to a low fee resolution or something like that, where they could agree to that.
Yeah, I think it's going to be like every other financial service product. Initially, there'll be fees, some mandated by the cost of delivery, some being opportunistic and encouraging the fee, like they do with both classic capital. It's $3 cheaper for them to take a mobile payment than it is for me to walk into the teller and deposit that check. But they're going to charge me 50 cents for the privilege of saving them $3. That's opportunistic. But that's what happens with the short term when we buy. So the answer is we don't know how to follow up. But those are the types of conversations we need to have. Think about who's getting convenience and therefore who should carry that burden. So the next one I want to talk about is, in a little more detail, is customer self-service with predictive analytics. So this is using everything we know about that customer relationship, about all customers, I think, and their past behaviors to determine what that customer wants to do at that moment of purchase, or what they care about, what they're looking to resolve. When, as I said before, when they took that phone out of their pocket, what were they trying to satisfy? So this is an opportunity to drive return on investment in a couple of different ways. First is call deflection. So if I can help you self-service, instead of calling into a call center or going into a branch and asking a teller, I'm saving the cost of that human interaction. If I'm making it more convenient for you and easier, we're going to drive customer loyalty because you say, wow, every time I have a question, the bank just answers it before I even ask it. They're a great bank. They always, have my mindset at heart. They're really taking care of me, and therefore I'm going to be more loyal to that bank. And the third is share a wallet, share a mind. If you have the ability to tailor offers and recommendations based on their predictive behavior, you can really make those offers targeted and help them sign up for e-statements if they really want e-statements. Help them sign up for overdraft alerts if they really want overdraft alerts. And therefore, you're going to get those value-added services because you're offering them in a way that they're more likely to be active upon. And we'll talk about that in a minute. So we know that customers are very finicky and are quick to exit an application. So what this chart shows is a rough estimation of how a customer flows through a mobile banking application. All your customers will come in and they'll look at the account summary list, see the balances, and as many as a third will abandon that and never drill down to the transactional details. Of those that do drill down, less than a third of the remaining population will go into the advanced functionality, either looking at the details of a specific transaction or going on to these advanced capabilities of the application. So what that means is when we do have their attention, we have to make the most of that interaction and provide the information they're looking for on the screen they have to be at. We can't wait until they drill down 5 screens to get to the golden nugget. We have to give them that up front. Otherwise, we're going to lose the opportunity to service the desire altogether, or they're going to abandon the channel and pick up the phone and call and ask the question. So what does that mean? That means presenting the customer what they want when they want it. As an account summary, that means having a key findings section. Maybe showing things such as suspicious transactions, transactions of note, things that, normally you spend all your transactions in Cleveland. These 3 transactions were in Florida, but here's, that's your trip somewhere. Okay, that's interesting to me. Or here's some that are suspicious, or here's your transaction for over $1,000, because you tend to always drill down on those. From the point of view, your wife's spending $1,000 per transaction, you don't want to know where that's at, right? So if you're always drilling down on those, maybe we'll show them to you right up on the summary page. Or that's an opportunity to show them those offers that I was talking about. Here's the offer to go to the faculty statement. On the left side, you have the transaction detail. So for those who do drill down into the transaction detail, we can tell them more about what that transaction is. Sorry. So when they click on transaction, based on the transaction type and information about that transaction, we can give them context-sensitive help. So if it's a gas authorization of $75, we can simply tell them gas stations traditionally put a $75 hold on your credit card when you approach the pump. They'll be closed out in 2 to 3 days and be replaced by the actual transaction. If they have a grocery store, they probably know what the grocery store transaction is. They recognize the name of the local grocery store. They go there all the time. If they're clicking on that, what they probably want to know is how much they spend on groceries in a month. So let's give them that summary information right then and there. If it's an online transaction such as PayPal, let's use the information in that transaction record to not tell them it's a PayPal, but to give them information about the underlying merchant and surface that information. So it's, give them the Google details on that merchant. What type of product does that merchant sell? Where is that merchant located? Oh yeah, now I know I use PayPal to pay that merchant because now I know who it is. With just the word PayPal doesn't really inform a lot to the customer. Thanks. Let's also, if we have an obscure merchant, let's tell them what type of merchant it is. It's a clothing boutique. Give them the address on the map, and let them know other nearby purchases, particularly if they're not in the home market. They might say, oh yeah, that was on my trip to Boca Raton, so now I know that's right, I did that while I was down there, and that makes sense. That's why I don't recognize the Cuban restaurant. And then once we offer up what we think they've been looking for, make sure you give them the ability to get more help. So if you didn't answer, if you didn't successfully predict their desire, let's tell them, okay, if you want to know more, either click again and we'll take another swing at it, or call the call center now. When you do call that call center, let's make sure they know that you've already been presented this information and you're aware of that conversation. So don't say, oh, it's a Cuban restaurant. Yeah, I know your mobile app already told me that. Let's get right to the meat of the conversation.
To your knowledge, has anybody ever contemplated opting chat with the phone, like chat?
Yeah, so video chat is actually one of the new technologies that are coming up. I didn't include it here. But, I actually, in my home market, they're actually starting to pilot teller windows that are automated. So you're chatting with the teller on a screen instead of going up to the counter. And you can get, basic queries, basic transaction capabilities. It's sort of a person-assisted ATM. And they're taking those same capabilities, the same staff that are servicing those in-branch teller machines and providing them to the mobile channel as well. BBA, I think BBA encompasses calling it. So Isocard Group added this predictive analytics that I was talking about. For 3 million customers with 3.5 million credit cards, they implemented this in 3 months with the objective of reducing service costs, increasing adoption of new products and services, and differentiating the quality of the customer experience. They had great success. I spoke to the CEO was saying the customers were very happy with it, pleased with how easy it was, but more importantly, the data. What happened was 88% of the interactions were able to be resolved by the information presented by the predictive analytics tool. Of those that weren't able to be resolved in band, the remaining 12%, 7% they were able to direct directly to the merchant. So what's this $39.95? Oh, that's a magazine renewal subscription. Call the magazine provider. They don't have to get a call from the call center because, again, it's reflected to the right source. So only 5% actually result in an inbound call to the financial institution. 45% of the targeted offers they made were acted upon, which is a phenomenal response rate, demonstrating the value of providing offers when you know what the customer wants.
Right, that's response, not acceptance.
Correct. So they acted on the business. Follow all the way through, depending on different offers, they have different results. Think of it as open. And more than 50% of the customers utilize this self-service technology more than 3 times a month in the 6 months following the launch. So that means these customers found it very valuable because they didn't do it once and say, oh, that was fun, kind of, book the feature. They went back and used it 3 or more times a month because they really found value. And you can see the types of questions they came up with, whether it's customer experience, fee-related questions, transaction analyzers, how much did I spend on gas in a given month, how much did I spend on groceries. Customers use really all sorts of different types of capabilities across the board. But overall, it was a very successful pilot for this particular group. So there's plenty of opportunity in predictive analytics, whether it's call center savings by deflecting the calls and answering customers at the moment of truth, whether it's increasing self-service transactional activity by automating recurrent transfers or bill pay. So if you are paying your bill on the due date every time, predictive analytics will allow us to offer you, you just want to go an automatic bill pay. And then the ability to migrate customers to cost-effective services like e-statements and account alerts. So again, it's about providing the customers with what they want and the tools to satisfy their own needs, rather than calling in and getting additional help. Next technology I'll talk about is mobile imaging. We're used to using our cameras on a device to take pictures. It's probably the number one thing people do with a smartphone. We all, anyone who has children will attest to that. I take pictures of my kids 5 times a day. I don't know when I look at them all, but I take a whole lot of pictures. And we're used to doing that on a mobile device. We want to be able to do that to bridge the last mile of transactions. So rather than taking a check and going into the branch to deposit it, I want to be able to convert that last mile into a digital transaction. One in 5 customers have said they had desire to use bill pay. Twice as many of those are already mobile bankers. So 42% of people who are mobile banking customers have said they want to use check deposit. And it really runs across different demographic segments. So it's really great way to reach all your customers and really happy. But let's look at the opportunity to use cases besides check deposit. As I said, that's almost becoming table stakes today. If you don't have it in your current mobile banking platform, you should be looking at it. It's one of those features customers saying they'll switch banks again because it's expected today. But there's a lot more. The check deposit is the first one. But the next big one I'm going to do is mobile bill payments. So the ability to take a picture of your remittance stub and from that detect the payee, the amount, the due date, and your account number, and set them up as a bill payee without having to go to online banking. Most mobile banking solutions, for security reasons, don't allow you to set up a payee through the channel. This is a way to accomplish this in a more secure manner because you have a remittance statement. So I know it's a legitimate payment, not, me just trying to steal your money.
So it's really like a one-off payment?
It's a one-off payment, or you can actually turn them into a payee at that point because you've now got the remittance statement to sort of validate that it's legitimate. The next is mobile enrollment. So now we want to sign you up for a loan or other financial instrument. We can get the information such as a picture, driver's license, a blank check, your tax returns, whatever we need to make that transaction, we can collect all at the point of the transaction versus having to mail it in or going and scanning it and sending it digitally. It's a very painful, difficult process to gather and produce all those documents. Just take a picture of them, it makes it a whole lot easier. We can go ahead and we can capture sales orders, we can verify people's identity, refill prescriptions, capture and process tax returns. All this can be done using mobile imaging. And the one I actually love the most is expense reports. I don't carry around a wallet or receipts anymore. When I have a receipt, I take a picture of it, and it automatically populates my expense report, ties it back to the card transaction, so I've got the verified amount, and it holds the SIC code so I know what type of transaction it is, it fills out the category for me, and I'm done. I spent off 20 minutes doing an expense report each month. It used to take me 3 to 4 hours, and I don't take the receipts to pay for it. So that's it on the next generation services. Obviously, there's a lot more to talk about, even the ones that we cover. But I want to talk a bit about mobility platform and capability. It's very important as we identify these next generation services to have an extensible platform. Most banks went out and bought a mobile banking software provider, either Monetize or Boundary or Mshifts, or Coney's product, and took the capabilities they had in their core product and deployed them. And that was table stakes, mobile banking 1.0. We can't wait for our providers to come out with the next service. These services that we're talking about, customers are planning for today, and if we decide to be a fast follower and roll it out when our vendor rolls it out, doing it at the same time the vendor's rolling out to all their other customers, so we're not meeting the market, and we're probably not meeting customers' expectations. So we need to have the ability to identify what specifically our customers want and build that ourselves. So it's great to use a platform. As I said, implemented a platform at 40 plus banks, so obviously I believe in them, but I don't believe we can't afford to be handicapped by it. So making sure it's extensible and the ability to customize it and add in your own features is very important. And if you have multiple lines of business servicing up these next generation products, we need to have them under. We need to have them all in the same umbrella. So I talked about the Fortune 50 insurance company I was at, and each line of business went out and created their own mobile banking application before we got them. And they did it with digital agencies, so nobody was talking to anybody else. And if you went out into the iTunes App Store, you would see 3 different applications, 2 of which had the exact same icon, and descriptions that sound very similar. And then a method for managing your account with this insurance company, for paying your bills, for getting information, blah, blah, blah. And that's where you had to be an underwriter to figure out which one was which, because they didn't have any governance in place. So if you're going to have multiple applications, consumers don't want to have multiple entry points. They don't care that you're organizing different lines of business. They don't want to know what the silos. They want to have one icon on their phone, click that icon, and then direct them within that experience to where they want to go. But not going too quick. Also, if you have your own extensible platform, you have the ability to tie it to your campaign management. So if you have an ATM machine, you're likely pushing digital offers to those ATM screens during wait times. Use that same campaign manager to push offers to your mobile channel. All this requires very extensible and well-developed middleware. I mentioned this at the top of the session. Complicated business rules and logic need to live within the middleware itself, not within the endpoint channel. I worked with one of the Canadian banks, actually, who, it's a great pomp and circumstance, bragged to me that they had a library of services that could give me any data I needed in the bank. Don't worry, you don't need to build any middleware, we've got it all. Great! This is going to be a very fast project. Took the specifications, that you call this service, get the accounts, display the accounts, and you're good to go. We went to user acceptance assessment. They said, but these aren't grouped and sorted like they are in online banking. I said, oh, what parameter do I pass into the web service to get that back? No, it's all grouping logic and sorting is all built into online banking. Oh. Well, now we have a choice. We could either pull out of online banking right into the middleware, and so it's both ways. Say middleware, which is the way we should have done it, or because you can't just pull out online banking and make a change on a willy-nilly basis, we end up rewriting the mobile channel, and now I've got two endpoints, both with the same business logic, and when they add a new account type, they now need to go change both those endpoints. They defeat the purpose of having middleware because they don't have the business logic built into the right point. You also need a complete data set. Working with a very large credit union here in the States that only had 2 months of transaction data available via their web services. Well, it's great for transaction history, bill payment, and the table stakes capabilities, but they were very interested in this analytical predictive analytics tool. And predictive analytics can create history. You can't do that with 2 months of data. So they basically said, we love the product, can't buy it today, we'll have to wait till we get our middleware up to speed. So that's why I said at the beginning, mobile ends up being a middleware transformation project, or so a transformation project.
So they were dropping out 15 months, they were dropping the history, not just not just claiming they were actually deleting it.
It was staying within the core system, but the web services were only exposed to the last 2
And you
years.
had to read the web.
So we could have created a separate data store that would hold 2 months, and in about a year we have something that we could have to go for transaction data that we can then mine for the analytics. But there's no way to get 2 years of data on the quarter today. So that was basically how hostile was the core, not a problem. So those are important problems to solve to make sure you can get collaboration between your online banking and mobile banking. What about when Google Glass rolls out? Are we going to create another set of endpoint logic and grouping and sorting structures? No, we have to have one set of middleware that can handle omni-channel banking no matter what the endpoint is. Whether it's Google Glass, iWatch, or whatever else comes down the pipe that we haven't imagined yet today. Now is the time to get your middleware in order because people are going to come too fast to be created later. So at this point I want to pause and talk about lessons across the industry. I appreciate those who jumped in today, but really I want to give you guys an opportunity to learn from each other. Talk about what other services you've seen for next generation capabilities. What's your experience implementing these services into your existing platforms, and what are your lessons learned from your experience? So if anyone wants to join the conversation, I invite you to use the microphones on the table so we can get it recorded for the session as well. Anybody? Key component of workshop is interactive participation. Okay, fine. Let's keep moving on and jump in as you guys have things. Really, I just want to leave you with the fact that mobile is not easy. It's about immediacy, so you really need to think differently. As I said, the detailed granular functionality that we see on a website doesn't make sense on a channel. So you have to stop back and rethink your interactions. I think today we have not gone far enough in that regard. We have not created that seamless, holistic interaction across channels. Context is critical, and we need to revise our roadmaps to make sure we get in that context and a holistic interaction. Mobile enterprises, most enterprises, and particularly small businesses, are unprepared for this because of the siloed nature of lines of business and back-end systems. So we need to figure out how to break down those barriers, both from a business standpoint and a technology standpoint. And it's required a great deal of planning and collaboration and understanding how to get the right experience to your customers. But finally, don't expect to get 100% right out of the gate. Nobody does. And incrementalism in this case is okay. It's in fact beneficial in some cases to get something out to a customer and go back 3 months later and say, here's our new version. We've added these features. We listened to your feedback when we added this. That's sort of the expectation of the mobile world. We have to have very strong feedback mechanisms. Customers expect you to listen to and respond to that. And by the way, if your application is downloaded once and never used again, like 80% of the applications tend to be, nothing gets customers re-engaged like a little push-up notification that says there's a new version of the app available. Let's go get it downloaded. It's one more chance to get them to come back and take a look at your offering. So if you came out with everything right out of the gate, you wouldn't have that opportunity to re-engage them. So updates can be a good thing as long as they're done in a thought-out plan manner. Any other thoughts, questions? Yeah, please.
So Owen Gingos, I work for Walmart Canada Bank, but we work very closely with Walmart Corp. So we're not just thinking about the card that we issue, but also how can we help the parent, i.e. the retail arm. And there's a lot of talk around banks and mobile. Have you seen any experiences that you can draw on that when you're a retailer as well as a card issuer, that when we're thinking about mobile emerging or other technologies, how can we get the point-of-sale systems and the debit terminals and those sort of systems to be able to interact well with the phones and other devices to prepare us for the future as well?
Absolutely. Any other questions? How we prepare the in-store experience to match up to the mobile to take advantage of customer capabilities. So one example I meant to actually comment on is the gap card that I showed you guys with the activation code. When I applied for that in store, when I was buying and trying out all my clothes, they said, "Oh, do you have a gap card?" I said, "No." I said, "Well, you're clearly trying out all the things. We'll give you a 15% discount if you sign up for a card today." I said, "Oh, great, I'll do that." I kept trying on things and going on my business. Probably spent another half an hour in the store before I actually made my purchase. Got into the counter, and then I had to begin the application process. I just spent half an hour trying on clothes. Wouldn't it have been great if they had taken a picture of my driver's license while I was in the middle of changing clothes and started that application process in the background? If you give your store associates mobile devices with imaging capabilities, they can do that, and they can start the process for you. And then we just complete the transaction when we get up to the register. So that's one way. The other is, changing your store layouts to facilitate mobile checkout. So if you look at the Apple Store, there's no register. You walk up to talk to somebody, you're asking a question about the product. You say you want to purchase it. They swipe your card right on the device. Somebody else brings out a purchasing product to you. You walk out the door, and your receipt gets emailed to you. So you change your whole structure of your store to service the mobile transaction. That's probably not realistic for people who aren't redesigning stores from scratch like Apple did. So if you don't have that luxury, then you look at things like line busters. You normally have the point of sale where you go through the traditional process, but when you get 5 people deep in the line, then your associates who are out answering questions on the floor, you grab a mobile device with a dongle or other type of payment process, card swipe technology, and process transactions on the floor. Help clear out that line and make things go faster. Other questions?
So you talked a lot about the success of mobile banking in the U.S., but what are your thoughts in terms of NFC and tapping at the point of sale? Do you think that the U.S. is ready for that? I know it's a very broad question, but I just wanted to get your opinion.
I don't think we're ready for it. First of all, iPhones don't support it, so until they do, most people aren't going to get familiar with it because the early adopters of technology tend to have iPhones, except the really powerheads like myself. But you're not going to see widespread adoption until Apple rolls out NFC. And more importantly, creates a value-added transaction around the tap. It's not enough to tap. It's not that hard to swipe the card with a piece of plastic. Actually, one of the guys in ISIS last year, joke that the big advantage to tap to pay versus sliding your card is there's all sorts of germs that live in that little slot. You're not exposing yourself to those germs. He was kidding, but the point is there's not a lot of differentiation. Slide, tap, it's the same thing. So if you don't add, additional value and make an incentive for people to do it, we're not going to see widespread value. And I have Google Wallet on my device. When I use it, every single retailer I've seen goes, "Oh, I've never seen that before. That's cool." First of all, 90% of the NFCs doing all they try don't work because they haven't been serviced in years. Nobody's been using them. And when they do work, the retailer doesn't know how to do it. So nobody's seen. I'm always the first person. That means it's not been widely common.
I know some closed loops, like Starbucks and their app has been very successful. Do you think that has any correlation with how NFC will be adopted? Well, first off, I know that it's not really my big job over time. It's not. And the Starbucks app is. And the Starbucks app is a closed loop app. Caters to your clientele. But you see any correlation or?
I think it supports what I said with that. There's a value add with that transaction. So in exchange for keeping value on Starbucks store value card, I get free refills on my Starbucks coffee. So when I go sitting there working and I finish my coffee, because I use my card and my app to pay, I get a free refill where I wouldn't have another one. So you have to have a gift to get.
Do you have line of sight to paying with mobile in a chip EMV world? Because in Canada, we have to enter PINs, and only relatively small transactions, i.e. less than $50, $75, whatever the prescribed limit is, usually by the association. Anything over that has to be card present, PIN entered, or you lose your chargeback rights. And have you seen from experience how that impacts mobile and how people have solved for it? Because I keep asking and nobody really has an answer for it.
What I've seen is sleds that have, in addition to the card swipe capability, a keypad on the back. It can't be an on-screen keypad because of all the requirements and security certifications you have to have an on-screen keypad. But they have, much like the sled you see in an Apple store, the aesthetic cards. On the back, there's also the 9-digit PIN pad. So it's the same physical transaction, but augmented. Correct. Yeah, so their mobile device would have this PIN pad. And that's just like the ability to verify and other numbers. Please.
I'm curious, kind of a two-part question, but the U.S. has always been kind of slow to the table with respect to mobile when you look at what's happened in Australasia and Europe. If you look at the advances that ANZ's been doing down in Australia and Micronesia, you look at what Grameen Bank did under Muhammad Yunus initially in APSA in South Africa and all of those advancements. The major driver of a lot of those was behind micro-lending. Do you see, maybe not micro-lending because we have a different economy, you see some of those markets, but do you see the lending side starting to be adopted through mobile channels where you don't have to go through a lengthy application process, but instead, maybe even so much as a car loan or something, go ahead and process that through your iPhone?
Absolutely. So I'm actually working with a small business lending company out of Philadelphia that, because the SBA lending rules have changed, they're really looking to change their business model to be a high-volume, high-transaction business, which means they need to sign up a lot of small business loans. Well, loans applications take a lot of time because you have to collect all the documents, you have to verify all the information. So we're looking at using imaging technology to capture all that. Take the credit card, take the tax returns, get it all into the system, and only create exception cases that need human intervention. So I think for especially not micro lending, low value loans, you're going to see a lot of that automated, and people assuming the risk because it's worth it to get the buy. Any other questions?
Talk about the challenges with consumer adoption for NFC in the U.S., but I see another challenge with consumer adoption for EMV in the U.S. What is it about the U.S. consumer, or what do you think that issuers and banks have to do in order to get people to change? And I think the EMV is going to be definitely be more of a mandatory. It's actually going to happen, whereas NFC is sort of a consumer. So it's just another behavioral change that I see happening, and I see some, if it's not done correctly, a little challenge and a little pushback. Like it's something eventually.
Yeah, I'm not sure I have an answer to how to fix the problem, but I think you hit the things to watch out for, which is if you don't have it done properly, if it's forced down as part of regulation, and there's not a value add associated with that service, there's going to be pushback. So, how do you make it as seamless as possible? Obviously, it's not seamless by definition, but how do you, minimize that pain point for the customer, and then how do you add value to make it worth the additional overhead? Yeah, I mean, right, change is always painful, so just trying to minimize that pain. Anything else? All right, well, I thank you guys for your time today. Please visit us at pervasivepath.com to learn more, and use the QR code if you want to download a copy of today's presentation. Certainly also my contact information in there, so if I need to reach out to you with any feedback, I certainly appreciate it, or further questions. Thanks.